corporate action and announcements and their impact on market prices. Hello everybody, I'm learning partner Sushila Hariharan, and if you're interested in a career in investment banking operations, trade life cycle, hedge fund accounting and corporate actions, do subscribe to my YouTube channel where we provide content-centric research focused videos on these topics. A big shout out to those members who have started taking membership for my YouTube channel, where we can actually provide numerical as well as real life case studies in each of the topics covered in these fields of investment banking operations and hedge fund accounting. So let's start off with what are corporate actions. Corporate actions, as you know, is the action initiated by the company which has issued securities like equities, preference shares, bonds, and has decided to create an event that will fundamentally alter the structure of these securities. It could also refer to activities like mergers and acquisitions, corporate restructuring, spin-offs, demergers. It could also refer to the third type of event, which are corporate action announcements with reference to undertaking tender offers and things like that. So therefore, corporate actions is a very vast subject, and primarily corporate actions are bifurcated into two types of events. The first is the mandatory corporate actions and the other is voluntary corporate actions. The mandatoriness of the corporate action implies that the issuer has initiated the corporate action and it is mandatory for the investor to accept the corporate action. Therefore, if the issuer has initiated a stock split, then all the investors who are owning the shares of the company to whom the stock split is applicable will have to accept that stock split. Of course, their approval is taken before the actual event takes place, but the announcement has to be made and then the AGM at which the shareholders have to approve the ratio of the stock split. In this case, we find that mandatory corporate actions, therefore, it's mandatory for the investor to accept the corporate action, and there can be no alteration or no modification of the corporate action. This means that if there is a stock split that's announced, then every shareholder who is owning shares of the company on the record date will be entitled to the corporate action announcement, and there can be no change at all, none whatsoever, with regards to understanding and the ratio or the dates, etc. It is mandatory for every investor who is holding the shares to get the corporate actions announcement in the case, entitlement in the case of mandatory corporate actions. Then what are voluntary corporate actions? So voluntary corporate action is an announcement made by the issuer in which the participation of the beneficiary has to be recorded by the beneficiary, and accordingly the issuer of the securities will act. So in a voluntary corporate action, the investor, for example, is holding common stock of the company, and the issuer has initiated a corporate action via a rights issuance. So a rights issuance gives the existing shareholders right to buy the shares from the issuer at a slight discount to the market price in a predetermined swap ratio. So the investor can choose whether to participate in the rights or not participate in the rights. If the issuer chooses to participate in the rights, if the investor chooses to participate in the rights, they must inform the issuer accordingly. So in voluntary corporate action, the issuer of the securities thus has to announce the corporate action, and they must wait for the investors' reaction or the investor's choice on what they're going to do. If the investor does not inform the issuer, then typically most voluntary corporate actions will have a default option. Okay, So that is something we'll be discussing in another video. But suffice to say for now, the mandatory corporate actions are mandatory for the investor. The voluntary corporate actions are voluntary for the investor. From the issuer side, in a mandatory corporate action, they are not going to wait for any response from the investor. On the other hand, in the case of voluntary corporate actions, the issuer will wait, and they will wait for what is the choice that is exerted by the investor before they proceed with the corporate action. The topic of this video was what happens to the stock prices on the different dates. So let's first discuss the dates. The first date is the date of announcement. When the announcement is made by the issuer, that is the date on which the investors, the stock exchange, the regulator, in our case SEBI, SEBI, become aware that the corporate action has been announced. This is a very important event because in this case, even the trading platforms, the stock exchange clearinghouse, the depository, the transfer agent, the custodian, all of them come into the ecosystem to understand how the corporate actions will be sequenced in terms of the events surrounding the payments. So once the corporate action is announced, along with the corporate action announcement, the issuer will also tell what is going to be the record date as well as the payment date. The record date is the date on which the investor who is owning the shares will get the entitlement. So let me break this up. So the first was the announcement date. In the case of the announcement date, there is going to be no impact on the stock price. Stock prices will move, increase or decrease because they might not be very satisfied. The investors might not be very satisfied with the ratio, or they may be overly excited about the ratio. So there is hardly any impact on the stock price on the announcement date. But from the announcement date to the record date, there is a lot of activity, especially as the record date comes closer. On the record date, the transfer agent, makes and compiles a list of all the investors who are owning the shares and how many shares they are owning in order to calculate and then distribute the entitlement. So you have the announcement date, and then you have the single most important date in corporate actions, which is record date. The record date is the date on which the investor who's owning the shares will get the shares. The investors who are not owning the shares will not get the announcements, will not get the entitlements. So in this case, the record date is closely linked to the X date. The X date is the date on which the stock starts quoting without the entitlement. So in a stock market like India's, which is T+1 rolling market cycle, rolling settlement cycle, we find that if the investor buys the share on the record date, their name will not appear on the list of investors who are entitled to the corporate action. So when do you have to buy the stock in order to get the corporate actions, in order to get the dividends or stock splits or to be entitled to the corporate actions? That is the date one day before the record date, that is T-1. So while the rolling market cycle takes an entire day, T+1, to transfer the shares from the seller to the buyer, in the case of corporate actions, the X date is the date on which the investor who buys the securities will not be able to get the entitlement. Okay, so if today is the record date, today itself the stock will be quoting X dividend. So if the investor wanted the entitlement, they have to buy it on a T-1 basis. So if I had bought it yesterday, then the entire ecosystem comprising the depository, the transfer agent, the issuer would have all recorded the change of ownership from the seller to the buyer on T-1, because on T date the stock is going to be quoting X dividend or X bonus or X split. In this case, on the X date, the price of the stock will fall as per the corporate action announcement, because every stock is a summation of its future expected cash flows. So on the X date, the price of the stock will quote X split, X dividend, X bonus, etc. And finally, the price correction has already happened. So when the payment takes place from the issuer to the investor, then we find that there is no there's not much of a change in the price. Then the price starts moving as per the demand and supply for the stock starting from the X date. So this is the price behavior of the stock with respect to the different dates. Announcement date, no change. X date, the price will correct itself. Record date and X date in the case of Indian stock markets, which follow a T+1 rolling capital cycle, are the same. So there is no change in the price on the X date and the record date. And finally, on the payment date, there is again not much of a change because the price has already corrected itself on the X date. If you like this content, do consider subscribing to my YouTube channel, because me and my team would love to hear your comments on this video. Thank you so much.